This is a great question because it brings me back to this why one would be more severe than the other. Dan's asking that there are two possible, saying the recession is inevitable, there were two causes, and what will this do to the markets? And I think we are moving into an environment, not in everything is doing badly kind of environment, but if the Fed is raising rates, and they are, and we've seen this in the last few months, bonds have taken a terrible beating, and they will continue to take a beating. Let me give you an idea of how severe this can get and why it can precipitate a recession. Right now, you get paid 1% for investing money overnight, 1% annual rate. Inflation is running at somewhere between 8 and 8.5%. Now, what that means is that the borrower pays back the lender in dollars that are worth, in real terms, 8 to 8.5% less. He pays the lender for the use of the money 1% a year. Effectively, the lender is paying him, in real terms, 7 to 7.5% a year to use his money or her money. So the Fed, in order to slow this down, has to raise rates above the rate of inflation. That's a long way to go, and it's going to constrain markets. So the bond market is, from my point of view, to be bold, a dead issue. It's going to suffer. If yields rise, that means stock valuations fall. Not necessarily the price, but the valuation falls because stocks are priced relative to bonds. The price-earnings ratio is really just a yield inverted. Earnings-price ratio is effectively setting your annual earnings as a percent of the price, so it's easy to compare to bonds. The more bonds offer in terms, as rates go up, the more pressure there is on stocks. And that creates a slowdown in the economy, which hurts profits, so you get the stock market down. Real estate and gold and maybe crypto, if it could get its act together, would be, and that there's a long tail that hangs on that, they might survive in this environment because they are like commodities. Not only gold, zinc, copper, all these things are in short supply, and even in a recession they might, and even in a recession with inflation expectations, their prices tend to keep up. But stocks and bonds, the classic investment vehicles, suffer immediately from the Fed. If the Fed holds back, they will suffer less in the interim, but then we get all sorts of economic distortions. One in particular is that as people see this inflation and worry about these markets, and they don't do as well as inflation, they start moving toward real things. That's why real estate and commodities do better. And that not only distorts pricing, takes away from stocks and bonds in the direction of commodities and real estate, but it also denies the business sector the money it uses to invest for productive activities, and that hurts the economy worse. So it becomes a delayed but a worse recession.